So there's a big misconception in the retail space at the moment that I feel like I should clear up. And it's the spread of the information of liquidity sweeps and liquidity grabs. And these categorically don't exist. And I'm going to cover the reasons they don't exist and try and explain it as simply and as clearly as possible. So, retail traders have access to retail brokers. We don't have access to institutional brokers and the same resources institutions have. So, when you open a brokerage account with a retail broker, you will see, unless you're in the US, you will see that you're basically just trading CFDs. So CFDs are just a contract between you and your broker, obviously called a CFD, so contract for difference. So this contract for difference is in the name, and this should already point out the how invalid a liquidity sweep actually is. So all a contract for difference is, it's just a deal between you and your broker to say that if the market goes up, they'll pay you. If it goes down, you pay them, and vice versa in a short position. So your orders, when you place a trade, regardless of the lot size and regardless of the broker, your orders are just going straight to the broker. It's just you're just buying a contract. That's all it is. You're not going into the live markets. Your money has no impact on the market. And the only situation when a retail trader's order would be put into the market, the live market, is when your broker would offer this option to you, or they would decide whether to offer this option. And this would only be for extremely large capital retail clients. This isn't available, and this isn't an option for regular people, and especially not people sat on Twitter saying that they're trading liquidity grabs. So, put it this way: both my colleagues, so Gabby and Joe, both trade large capital, 6-7 figures, live money. Neither of them have their capital put into the live markets. They both trade CFDs. Their positions have no effect on the markets, and these are both verified professional traders. So I really doubt that your guru on Twitter or YouTube or Instagram is trading live like that. So there is another reason liquidity grabs don't exist. It's because you don't have access to information. All you're doing is just technical analysis. You're drawing lines and saying there's liquidity here. There's no proof, there's no evidence, there's nothing there to say that this is true. So it's a very it's a big red flag, in my opinion, when you see these traders on social media that say trade like this is a strategy, trade these liquidity grabs, this level, because they don't exist. So it's a very simple thing to understand for anyone that has had any sort of brain cells. And to be quite honest, I know it sounds harsh, but it's true. Anyone that's done any sort of research and understands how brokerages work, how the markets work, and how they move, will understand this and should already know this. So let's say we have a market that's trending like this. I know that the way people tend to draw these liquidity lines is something like this. So they'll mark up something along these lines, which in my opinion is just a support level. And then they'll say, this is where the liquidity grabs are. Now, this just isn't what happens. And to be quite frank, I understand why people would say this if they are lacking the knowledge, because it does seem that way, but it's not. This isn't what's happening. There's no one out there looking at your stop losses, mainly because no one cares about them because they're too small, and for another reason, because they're not even in the markets. So when this happens, what do you think is happening? Now, I know people will say, again, this is a liquidity sweep, and it's not. What could be happening here is there are large market participants saying, I bet the market's going down, putting in, for example, let's say 500,000. And then there's someone else that's saying, I bet the market's going up, and then putting in 1 billion, for example. This is all hypothetical, of course, but this can be the reasoning. So obviously we get this initial push down with the large push, and then we get the larger push to the upside after the higher quantity order comes in. And this is what can cause this move down and then the push back up. Or it could just be a natural market move. Now, anyone who's been trading the markets for any sort of long period of time will know that drawing simple, thin lines against candlesticks like this is not a good idea. And the reason is because the markets aren't perfect. They don't move pip perfectly. So you may see something like this, where the candle comes down and then we get another push like this. Now, again, this is where people say it's a liquidity sweep, it's a stop hunt, it's whatever sort of excuse they want to use, and this isn't the case. This area is still respected. It's just you've drawn a very small, stupid line and seeing what you want to see. It's confirmation bias, and this isn't, this isn't real. And this is why when you look at any sort of professional trader's chart, whether it's a retail trader that used to work in institutions or you look at bank reports, whatever it may be, any sorts of levels will be marked with a box rather than a line. And this is to allow that imperfection in the market, to allow the sort of movement in the area rather than a simple straight line, because these are broken with very simple moves. Even half a pip will then invalidate the support or resistance. And that's basically it. I mean, I know that there's a lot of traders out there that sort of use this strategy and say, oh, there's a liquidity sweep down here, or there's liquidity lying at this level. And to be honest, it's fine if that's how you want to trade. You want to trade using levels like that, that's fine. But I feel like it's I feel like it's a very silly thing for traders, especially if you want to take this career seriously, to say that there's liquidity sweeps and stop hunts and those types of things happening in the market. And again, your orders aren't in the market, so whatever happens, it's indirect to you. All you did was put your stop loss too tight in a stupid place. So let's say you entered here, at this level here, you had your stop loss right at the support, which you should never do anyway, and then you were taken out. And this is how people then start saying that the markets are manipulated, they're rigged, there's an algorithm, there's whatever it is that's working against them, because no one wants to take accountability, no one wants to do the research, people don't want to put the time in, and it's just a victim mentality, to be quite honest with you. And if you still watch this video and don't believe me, then all I would say is call your broker, call your account manager, talk to anyone that has any sort of market experience and has real knowledge, and just ask them. They'll tell you exactly the same thing, but probably in a more nice way. But yeah, this is just the quite God's honest truth of the markets. So if you come to me saying you trade liquidity grabs, just know that I won't take you seriously. And anyone that does try and teach you this, stay away from them, because they are clueless, to be quite honest with you. And that's it. That's all I have to say. I just want to get this off my chest because it's really frustrating seeing all this, because people lose money. They lose money every day, and they lose a lot of money trying to trade these concepts that are built on things that don't exist.